Good evening. Welcome to the Hurley Investments Market View commentary for the 17th of June, smack dab in the middle of our month. I must apologize for last week. Last week, just for the record, I did about 6 miles chasing cows. It's a hilarious story. The cow is out for 5 days in the mountains behind our fields, and the good news is it was found. Special thank you to the Highland and Alpine Police Department. I don't want to thank all the stupid people that thought they knew better than we did and had issues with us up in the mountains with motorized vehicles and cows and / horses, but that's just the way the cookie crumbles sometimes. I'm kind of hoping Bosserman shows up today. They sent me a pretty interesting email and I appreciated it. But okay, let's get into the real stuff. Let's, in fact, actually, I just saw a couple things that came up. Yes, we're going to enjoy eating number 5 first. And he has a nickname that we're probably not going to say publicly where it can be heard, but it is a 4 and a 5-letter word that are just going to be between us. Okay, a couple people have asked some questions. So here I am, again, going to go through answering the questions. I'm going to tell you thank you very much for reaching out to me. I always appreciate a text, a email, and something to just make sure that I can do the best to answer your questions. Maud, thank you for joining us tonight. Pleasure having you here as well. Maud is my resident doctor that I go to and make sure that I'm doing things on the up and up, right? She just sent me a lots of laughs. Okay, so here we go. Today I'm going to go through a couple of your questions, and I want to make sure that you always know what your money's doing to the best of our ability. And there are 3 of us now that are looking at things. I used to tell you I was not a fan. When you have 1 or more people trying to make an educated decision in the stock market, it lays a lot of blame. It lays the foundation for an excuse when things don't go the way you had planned. And you can't be in the market with excuses. You either got a program and a system that's going to work or you don't. You either have a way to protect in downturns in the market or you don't. That's the real life of trading in the market. A bunch of you have talked to me about large amounts of cash and how we're creating that cash for you. So we obviously want to keep 5 to 7 to maybe 8% cash to buy protection, to look for an opportunity that we can jump into something. And when we say jumping into something, usually we want to purchase 300 shares or more. And I'll explain why we do that as well. But really quickly, a question for the group: how does cash get added to your account? And there are a couple different ways, but just for the group, how does cash get added to your account? And there are a couple different ways that this can happen, but I want you guys to understand how cash gets added to your accounts. So go ahead and type in, I'm looking for answers on, hey, cash can get added to my account by this, by that. And I'm going to do a quick comment on it. So we have one, put, short calls, dividends. So I love those. I'm going to go ahead, I'm going to do it a little bit different. Dividends is one way. When I say puts or short calls, I'm going to say taking profits. If that's okay with you, taking profits, creating, and I'll say it that way too, creating cash through option strategies. Taking profits, maybe we'll put that more to the stocks, right? Do stocks and options. We could also do it through deposits. That's something we don't typically ask you to do, but I know there's some of you that did have accounts that we were obviously putting money in quarterly for defined benefit plans and so forth. So yes, I mean, that's how we keep adding cash. Most recently, the sale of Meta and profits from puts are the cash creators. So that's how we're creating cash in your account. Now, pretty neat. A couple of you are like, well, what are you going to do? Right? Some are like, oh, we've got all this cash. What are you going to do? And so that's the next question. When you have a lot of cash, I always, well, I can't spell, always get the question, Kevin, what are you going to do? And my answer is always the same. Invest it when I see a good opportunity. And most of you should know here, we don't just throw money into the market. If there is not a good opportunity, we are not going to just put your money into the market because we can. That is not what we do. We are not saying, hey, we've got all this cash, let's dump it in because we're going to charge. If there's a lot of cash in your portfolio, there's a lot of cash in my portfolio. And when people come in, our first line of thoughts are not, hey, what can we throw you into? We don't trade that way. It's what opportunities do we have there to push money into? We will never just put your money into something because you have money. And there's a reason why that I might as well just go ahead and say it right now. Just putting money into something, diversification, right, is not a smart investing opportunity. Diversification never protected someone. Think of the market crashes. Everything went down. I mean, I can go ahead and I can say 3 different things that people are going to probably get pissed off at me saying, but we might as well say it. Diversification is never protection. Where if you're diversifying, you should never be in a fund because they're so damn expensive with a premise that diversification is protection. And anyone that's ever spent money on a financial plan was taken because the financial plan is based on averages, compounding interest, and the stock market doesn't work that way. The stock market has never, ever been a compounding interest growth machine. It doesn't work that way. It has never worked that way. And until someone has the guts to say that, people are still going to get hammered in the stock markets. Now, I'm not saying my methodology doesn't mean you're going to always make money. You'll never lose money. It's just when stocks go down, we have something to combat a down market. In fact, we have something through Bear Stearns that proved if a market slash stock slash fund goes out of business, but it can use options, you can still make money on a failing institution, on a failing company, on a failing equity position in the market if you can use options. Something to bring out, because I've got a couple of you that have different size accounts, and you're like, well, Kevin, you're killing it on my big account, and my smaller account, you're kind of sucking it. Let me ask a question to everyone here. Is it easier to make money? Is it easier to make money with more money? Let me go ahead and take this one out. Is it easier to make money with more money? A simple yes or no. Is it easier to make money with more money? Yes, of course. Now, the real question is, though, why? And it really comes out to a couple different things. Number one, there's more opportunity at a higher risk / cost. You have more opportunity. You can be in 8 different positions instead of 4. You can be in more expensive positions versus lower, maybe not S&P 500, stocks. Number 2, more money allows for an easier investment opportunity. And you're going to go, easier? You're kidding me. Easier because the bigger accounts, it's not an exact comment here, but in general, the bigger accounts allow us as money managers to take longer to get into positions. The terms of making money aren't as immediate. The mentality of individuals that come in with millions of dollars is significantly different than those that come in with $1 million or less. I don't know if that's experience with money, experience with life. Bad experiences in the market could be a huge thing. But more money allows for an easier investment opportunity for us that manage the money, because in essence, it gives us more time. And that's the key. More money gives us, as money managers, more time. And the honest truth is, time gives you the ability to adjust. So time gives you the ability to adjust, make more trades, let's just see more opportunities, make it right, allow for things to come back, to get lucky, to have the market allow the numbers that you've worked to get to where you want to be. So we look at everyone the same, and we don't have a bias to one person over another based on how much money they have. It's just the cold hard truth is the more money you have, the easier it is for us to find an opportunity that is a more volatile, risky, expensive position to be in that gives you more opportunity. Really, more risk a lot of times in the market does mean more opportunity. With that said, Disney, we added puts and then took them right off again. We had a fake out. We put puts on at 100, a little under 100. We thought it would at least go down and touch the 200-day, which was 97.80 something. Right now it's at $98 even. We thought we had a $3 cushion on the way down to make up some money with puts. Instead, Disney turned on us. So here we are where we're going to lose $1 on $1.80 of movement. But the short answer is we got taken for a ride. We got taken for a ride and we thought we could make money, and then we ended up losing money. I'm going to bring the same thing in for Apple. Boy, we're making a killing on Apple. The but side of things is, though, we had a couple weird days. Here's the easiest way to say it. Apple, we played long calls, switched to puts, and then lost money coming and going. So on Apple, yes, we made money from 95 to 216. Yes, we're up $31.67 on the stock. And yes, we made money on the puts previously. But in this $31.67 to the upside, you're going to notice a $2.80 loss. Well, Kevin, are you putting on the wrong positions? I noticed you went calls and switched to puts. It was rather quickly. When you have some days that move like this, that move like that, or the black one where it's right in the middle, up and down and finishes slightly positive or slightly negative, either one, it's a hard day in the market for us. We want to protect profits. My goodness, $31.67, 31.67 divided by 195 is a 16.25% profit. So we want to protect that 16.25% profit. The question is, why are we so protective? Why are we so protective? We're so protective because talk about an overvalued stock. We took this a week ago. Average target price was 205 and 4 cents. The lowest target price is 164. The highest is 275. Our price was 203 and 86 cents up to 213. Apple is more than fully valued. Apple does not have growth opportunity in its future. This is the funniest part, which I think is hilarious. Apple today, after less than 1 month of pay later loans or purchases, credit card purchases, canceled the program. This pay before you buy kind of stuff, buying on credit cards, the risk to Apple was not worth it after less than a month. And I think, but Apple after less than a month realized to play credit card, pay before, pay later programs have a large number of people that don't pay later. So they canceled their program. I wonder how many times they got gypped on it already. It's an issue. It's a problem. It's not something Apple wants to deal with. All right. Micron. Got into Micron around $68 to $76 for most people. And today, Micron was one of our huge winners. It's unbelievable. And please don't feel bad if you don't have all of these positions in your portfolio. Again, it comes back down to more money is easier to make money on more money is easier. But the short answer is Micron today finished up at 147.83. And it's up after hours. We're pretty close to pulling a double on Micron. And they still haven't announced their billions of dollars they're going to get from the chip program the United States is doing. We will sell out of Micron when they announce and get the push higher for the government chip program. Could we stay in it? Yes. What we'll probably do is a lot like we did with Meta. When we sell out, in case we're wrong, that it still can go higher, we'll use an option strategy that will act as a stock replacement. So yes, it can still go higher. So when we sell out, we will add a stock replacement strategy. And the reason why, we're hedging our bets. We're hedging the fact that, you know what? Meta could still go higher. Micron could still go higher. So we'll add a stock replacement strategy there so that we still will take advantage of continued upside movement. Kevin, Baidu is such a dog. I can't believe you have me in it. I just happened to take a screenshot. Today, if you were in Baidu, you made more money on the way down than the stock lost. But Kevin, Baidu's down $12,945. You're only up $3,857.55. So just a comment. Everyone has been in Baidu for years. Even in this account that they're only at 300 shares, we made a killing on Baidu from 350 all the way down. The neat thing is, yes, I could sell off Baidu for a loss on the stock for your account today. But your net return on Baidu is well over 100%. That's the beauty of taking time into consideration and having all these options work for us through all the years that we've been in it. Welcome to the beauty of options. Last but not least, NVIDIA purchase price of $125 closed today at $130.98. So we are up over $5 already. This was purchased reluctantly to put money from the sale of Meta. We look ridiculously smart right now, but I would not expect NVIDIA to continue higher. It needs an earnings catalyst to push it higher. All right, big picture, a really good read this week in the big picture. If the stock market is a mega cap world and every other stock is just living in it, that can be better for the stocks and worse for others, but there is no mistake in the performance metrics where the investor interest is concentrated. The market cap weighted S&P 500, what we all go by, up 13.6%. The equal weighted is only 3.5%. The Russell is down 1.3% year to date. The S&P mid cap index is up 3.17. It's defined in these 7 stocks. That's where the growth has been for over a couple of years. What this all means. What it means is the rest of the market is traded more conservatively as money flows have favored the biggest of the big for their earnings power, their financial strength, their leadership positions, and their momentum. It also means the market cap weight S&P 500 has been in an uptrend because of its leadership. In simple common sense, for the last year and a half, our market growth has been in 7 stocks. It's even to the point now where we have not so smart people that are creating an ETF where both Microsoft and NVIDIA will likely have a weight of around 21% in this ETF. $71 billion in assets under management. And it's going to be weighted roughly in 7 stocks. You want to see something where 50% of the value will evaporate overnight as soon as we run into some kind of tech scare. If you're in the XLK fund, you're going to be in deep trouble. I'm not a fan of always having protection on, but if you're going to take this kind of risk, it might be really smart to always have protection on. Okay, one last comment. I'm going to put it right up here, more towards the, well, let's just put it right here. Juneteenth. This Wednesday, the market is closed. So this Wednesday, the market's closed for Juneteenth. Juneteenth, we've got a holiday that's made up right now that gives our market a day off. Please enjoy a Wednesday where the market will not be open. What that means is we'll probably have some lower volume tomorrow and some lower volume towards the end of the week. But yes, we do have Wednesday as a holiday. All right, sorry about that. We've got 28 to 35 mile per hour winds out here, and I bet we just lost our power for a second there. But where our markets go this week, I'm going to say higher. The Dow is bearish, but the S&P is bullish and overbought, and the NASDAQ is bullish and way overbought. So if you were to guess, do you think I'm going to push for protection or no protection in the near future? Looking at these charts, being overbought, yeah, protecting big time. We're really close to pulling the trigger on getting puts on for protection. That's what we're looking at. It might give us a head fake, come down for a little bit, then head back up. We're okay. We're looking to protect some really good profits this year. So don't be surprised in the near future if you see protection really going on. With that said, this is an election year. So I'm just going to make a comment. The people that were saying, oh, Kevin, wouldn't it be better to sell and make and go away? If we did that on the NASDAQ, $5,700 to $1,700, you would have lost 2,000 or roughly 13.33% upside opportunity on the NASDAQ. If we take a look at that on the S&P, roughly 5,000 to 54.73, you would have lost almost 10% upside opportunity on the S&P 500. Yes, we are trying to outguess the market, but it's our protection on the puts that gives us this opportunity to do that. Not much earnings coming up. In fact, I think, yeah, these are right. Nike on Thursday, Walgreens boot allowance. Wednesday is Juneteenth, so the market is closed. Economic reports. Empire Manufacturing was today. Retail sales will be the big one tomorrow. Housing starts and building permits on Thursday, and leading indicators on Friday. Yes, we still have our Baidu protection on at 110. Already took profits on those ones. A couple of you asked me this week on Baidu, and I found it really interesting because I have a couple different articles here. But investor alert, 3 companies poised to outshine Google by 2032. Baidu, AMD, NVIDIA, Meta. No, we're not waiting for 8 years to beat Google, but just some things to better understand and read about Baidu. The 3 most undervalued long-term stocks to buy in June 2024. Deere, Total Energies, and Baidu. So it's coming up quite a bit on people's radar. Soon enough, it'll fall into market favor and off they should go. Someone asked me about India. As I said, I was looking into it. India's GDP growth likely to outpace China's in 2024 through 2008. I think you can make a case for it all the way out to at least 2035. But a very interesting article on India. Apple faces pressure to show off AI following splash event at OpenAI. Google and Microsoft are obviously its competitors. And let's face it, Apple is piggybacking. They are not coming up with AI. In fact, you want to hear something interesting? McDonald's has quit the AI from IBM. I think it's called Watson or something like that. There are positions for AI, but those positions in the world obviously aren't designated. And right now, to call stock screeners artificial intelligence is kind of foolish. So there will be an opportunity for AI in the future, but right now, Apple doesn't have it, and screeners should not be considered AI or artificial intelligence. Weak U.S. gasoline demand compounds pressure on oil ahead of OPEC meeting. If you're wondering why gas is so low, yes, it is impartial because we're draining our reserves, but there are other political events in place here. Again, I'm typically not a fan of oil. I can't wait to get out of MRO, but a great article to better understand oil if you're looking at it. Another article on the Amazon Prime. I've never been in Amazon. It's just a retail company. It's the online retail company like Costco that's overpriced with a membership. Is it worth it? It's for you to judge on your own, but it is worth it for my family. Please read through the article. And then I've got that XLK ETF and the weighting. You got to know what you're investing in. And I felt like this was a great article once again to show people just because it's an ETF or an index ETF, boy, it really is important to know what's in these ETFs and if it's worth investing in. With that said, what questions do you guys have that I could try to answer for you today? Are there any questions you guys have that I can have an opportunity to answer for you today? Yes, Wednesday the market is closed. And you will have a webinar on Thursday. Usually our webinars are Thursday mornings, I thought. And just to let you know, next week, Keith will be taking care of all the webinars. Monday, Tuesday, Wednesday, Thursday, I'm on the Brazos River in Texas. And Friday, we have a celebration of life for my niece that passed back in October. We're just getting the brothers and the families together to remember Shelby. Yes, we will have a webinar on Thursday for you guys, but I will not be around next week. Tony, we are trying to get my Scott to call your daughter to take her out on a date. It'll be kind of funny if she tears them up one side and down the other, but I think those two are kind of cute together. Tony happens to live pretty close to me, and our wives are best friends for years. Best friends since church service. All right. Any other questions you guys have that I can answer for you or try to answer for you? And actually, if you don't mind me asking you, did it make sense on what I was trying to share today on portfolios and the opportunities? Did that make sense to you guys? Or was I just jabbering at you today? Yeah, made sense. Okay, perfect. Yes, perfect. All right, then. Hey, guys, have a wonderful day. You guys take care. I appreciate it. I look forward to seeing you guys in 2 weeks on Monday. Until then, know we're watching portfolios, so you don't have to. We are making our best educated decisions, but the emphasis is on adding protection sooner than later because of the time of the year that we are, because indexes are overvalued and overbought, and we have a lot of stocks that are way overvalued and misweighted in funds that they're in. Guys, have a wonderful evening. Look forward to talking to you in a week. Take care of yourselves, and I'll talk to you then. Bye-bye.